Hello, my name is Vân and I will be with you for the chapter 4 of the course Introduction to Financial Accounting. Previous chapter we have discussed accounting for service businesses. These businesses obtain revenue by providing some kind of service. In this chapter, I will introduce to use accounting practices for merchandising business. So we will look at some of the subject as follow. We record and report on inventory transaction using a perpetual system. We explain the meaning of term used to describe the transportation cost, cash discount, returns or allowance, and financing costs. We will compare and contrast single and multiple step income statement. And if we have the time, we use the common size financial statement and ratio analysis to evaluate managerial information performance. So, learning objective number 1, record and report on inventory transaction using a perpetual system. Merchandising businesses generate revenue by selling goods. The goods purchased for resale are called merchandise inventory. Merchandising businesses include retail companies, companies that sell goods to the final consumer, and wholesale company, the companies that sell to other businesses. So the inventory costs are shown on the balance sheet in an asset account named merchandise inventory. The inventory costs are frequently called product costs. Example of inventory costs include the price of the good purchased, the shipping and handling costs, transit, insurance, and storage costs. In addition to the above, there is another cost that are not included in inventories are usually called selling and administrative costs or period costs. Example of period costs include advertising, administrative salary, sales commission, insurance, and interest. So here we will look at how we calculate the cost of goods available for sale. The amount of inventory that is available for sales during a specific accounting period is calculated as the beginning inventories plus the purchase. The cost of goods available for sales is allocated between the asset accounts, merchandise inventory, and an expense account called cost of goods sold. The merchandise inventory account reports the cost of inventory items that have not been sold during the period. The cost of items sold is reported in the expense account cost of goods sold. The difference between the sales revenue and the cost of goods sold is called gross margin or gross profit. Selling and administrative expenses are subtracted from gross margin to arrive at a net income. The most modern companies maintain their inventory records using the perpetual inventory system. This inventory system adjusts inventory accounts perpetually, meaning that continually throughout the accounting period for each purchase or sale of inventory. Let's see how the perpetual inventory system works by looking at transaction for June's plant shop. So we have event number one. June's plant shop acquired 15,000 by issuing common stock, right? So this transaction increases the cash assets account and increases the common stocks equity account. It is classified as asset source transaction. Here is the effect of this transaction on the financial statement model, right? So we have a cash increase 15,000, inventory there's no effect, the stock increase 15,000, and the cash flow of financial activity inflow of 15,000. So the transaction number two, the companies purchased merchandise inventory for 14,000 by cash. This transaction decreases the cash assets account and increases the merchandise inventory assets accounts. It is classified as an asset exchange transaction. Here is the effect of this transaction on the financial statement model. So we see that the cash decreased for 14,000, inventory assets account increased for 14,000. So in general, there's no effect on the total assets account. But we have a cash outflow of 14,000 for the operating activity. Event number three, June's plant shop recognized the sales revenue from selling inventories for 12,000. This transaction increased assets for cash for 12,000 and increased equity revenues of 12,000 also. This is classed as an asset source transaction. Here is the effect of this transaction on financial statement model, right? So we have a cash increase, revenue increase, the net income increase, the cash flow increase. Now in the second part, we explain the meaning terms used to describe transportation costs, the cash discount, returns, or allowances, and financing costs. In fact, we have some transaction, but to reduce due to the time limitation, I will not give you the detail of this transaction. Just give some definition. So as you know that the purchasing inventory often involved in other costs. So first about the transaction cost, the transportation cost, inventory returns, purchase allowances, and cash discount. So what does it mean, the cash discount? In fact, here we have some transaction, but we will not cover for this course due to the time limitation. The cash discounts are deduction from the invoice price granted to induce early payment of the amount due. If payment is made during the discount period, a reduction is given. If payment is not made within the discount period, the full amount of the invoice is due. Right? So you can see that this we call this a cash discount. Now we have another cost, that's the transportation cost. Transportation costs are something sometimes included in the cost of merchandise inventory. For example, when buyer pay transportation cost to get a merchandise inventory to them. The transportation costs are included in the merchandise inventory cost. The FOB terms are designed when title passes and who pays the transportation cost. FOB stands for free on board. So if the shipping terms are free on board shipping point, that means that the ownership transfer from the seller to the buyer when the seller provides the good to the carrier. It also means that buyer will pay the transportation cost. On the other hand, if the shipping terms are free on board destination, that means that ownership transfer from the seller to the buyer when the buyer receives the good. It also means that the seller will pay the transportation cost. So if the goods are shipped free on board FOB shipping point, then the buyer owns the goods in transit and will pay the transportation cost. This transportation cost will be added to the merchandise inventory account. So now we talk about the gain and losses differ from revenue and expense. When the companies sell merchandise inventory for more than it costs, the difference between the sale revenue and the cost of goods sold is called the gross margin. However, when the company sells land for more than sells the good less than its cost, right? So the difference between the sale price and the cost is called a gain. Why are there are two different terms? Buying or selling land is not the company like you plans primary business. Therefore, the gain from the selling the land is not likely happen on ongoing basis. If the land sold for less than the cost, the difference would be called a loss. Gains and losses are shown separately on the income statement to communicate the expectation that they are non-recurring. So for the gain or losses here, we can understand that this is a sell or buy something that's not not from the operating activity. Maybe sell the land, they may sell the car, or etc. Okay, or maybe they can earn from the interest rate. So in this part, we compare and the contrast single and multiple step income statement. So what does it mean, the multiple income statement? Here is the income statement at the end of the second year of the company. Notice that it is more informative than one which simply subtracts expenses from revenue. This is called a multiple income statement. Income statements that display a single comparison of total revenues and total expenses are called single-step income statement. A multiple income statement separates cost of goods sold from other expenses in order to show the company's gross margin. Also note that operating income is reported separately from net income. Non-operating item, which include the interest expense or expenses and gains or losses on the sales of assets, are reported after operating income to arrive at net income. So now we look at another subject determines the amount of net sale, right? So may have to look at the net sale. We have there's three events may affect the net sale. The sale of inventory often involves in the inventory's return, meaning that the client there's effect, right? The purchase allowances and the cash discounts. In fact, we will not discuss in the detail, but just we purchase alone. It means that like commission you will have to pay for the sales representative of a broker. So we not discuss on this very detail because it's not really time for us. So now we look at nearly another topic. We use a common size financial statement and ratio analysis to evaluate managerial's performance. So then look at what does it mean the common size financial statement. The this contains the company's in 2013 and 2014 income statement. They are called the common size financial statement. In common size income statement, all items on the income are stated as a percentage of net sale. Percentage of net sale here, right? So the net sale is 100%. All other items will compare to the net sale. So assume between the 2013 and 2014, June decided to relocate her planned shop in an upscale shopping center. The rent is higher, but she believes she will attract more customers who are willing to pay more for her plans. Analyzing the common size statement suggests that June strategy did increase the profitability of her business. Gross margin increased from 33% to 53%, and the return on sales increased from 25% to 33%. Okay. And now we look at some of the financial ratio. This is for you. The first one is the gross margin percentage. The gross margin percentage indicates how much of each sales dollar is left after deduction the cost of goods sold to cover expenses and provide a profit. So it is calculated as the gross margin divided by net sales. Other things being equal, the company with the higher gross margin percentage is pricing its products higher. Another one we call is the returns. In practice, the net income percentage is frequently called the return on sales ratio. Return on sales expenses, return on sales expresses net income as a percentage of sale and provided insight into how much of each sale dollar is left as a net income after all expenses are paid. It is calculated as net income divided by net sales. Other things being equal, the company with highest return on sales percentage is doing a better job of controlling costs. So thank you for your kind attention. This chapter introduces the accounting practice for merchandising business. And see you in the next video.